Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. There is this company that I wanted to add to this portfolio for a very long time, and one of the brothers in the Discord mentioned it today, and I thought, you know what, let's have a look at this company. This is Lind. Lind is one of those companies that has been on my watch list for a very long time. It is in the chemical side of things, is material sector, and they do very similar to what Air Product and Chemicals does, which is one of the companies that I own in this portfolio. So what I want to do is I want to dig deeper into and understand how the business is actually performing, and then I'll give you the valuations and the dividends and all of that in a second. But before we do that, as always, I would really appreciate if you can join us on the Patreon account, if you can like the videos. It does not cost you a penny. It takes about a second to actually press that like button, and it really means a lot to me because it takes a lot of time and effort to put these videos together. So I would really appreciate if you can do that. Right, let's have a look at the company. So the company, like I said, is Lind. This is currently trading $409 per share. For the 1 year, it's up about 24%. Closer to 25%, a year to date or up 28%. So it's actually beating the market because the market is up now 25%. So it has beaten the market this year, and the highest it's been this year is $434 per share. So it's about less than $30 from where it is right now, and it has a PE of 29. The EPS right now $14. So what I want to do is I want to look at the financials first of this company. So if we go to the financials, I'm using Seeking Alpha. So if I go to financials and go to income, you can see the revenue here since 2013, where it's been. So 11.9 to $12 billion. So there's a bit of a decline there. Sorry, a bit of an increase in there. Then there's a bit of a decline in 2015. $10 billion, 10.7, 10.5, 11.3, and then because of COVID in 2020, somehow actually it's declined, about $1 billion. But look at this massive jump from 2018 to 2019, from 14 to 28. So they must have acquired another business that they basically added to their business. So that cannot be a massive, basically just organic growth. Or they might have merged with another company or so on. So something must have happened. So if you're really interested, that's something to find out, and what is that's done for the business, because you can see what is done for the business top line, but it will be interesting to see what is done for the bottom line as well. So 27, 30.7, 33, and then 32. Bit of a right now trailing 12 months, we're basically expecting about $32 billion of revenue. Now if we look at the net income and to see what that has done to the net income, from 1.7 to right now $5.9 billion, which is quite healthy. Now this is the year, so 2018, 2019. Okay, so this was the year that they had a massive jump in terms of revenue from 2018 to 2019. If we look at the same thing, 2018 to 2019, it actually declined. So from $4 billion to 2-point-something billion. So they must have used some of that money. Whatever it is, will be interesting to see for the rest of that information. Now, a couple of more things. Lind, 199 billion market cap. So it's a huge company. It's a mega cap. And dividend is 99% safe. That's the highest any company can get. Right now, dividend yield of 1.24. And the payout ratio is only 36%, which is quite nice. So they have room to grow that dividend, and they are growing really nicely. So 9% growth, and they have also announced, I think it was October, November, they announced $15 billion of buybacks. So they're buying back their own shares. They're increasing the dividend about 9%, and basically latest 8% for the last 5 years. I would have liked if this was double digit, but it doesn't matter. For the 20 years, it is double digit. So they are growing quite nicely. And as you can see here, this is absolutely beautiful to see. Now, the next thing we need to look at is the dividend growth streak. So 30 years of increasing. So this company is in the S&P 500, as well as paid dividend, increased that dividend for over 25 years. So that means they are a dividend aristocrat. Right now, you'll get $5.10 for every share of this company that you own. It looks like it's overvalued based on this valuation. As you can see, the 5-year average is actually lower. Okay, the dividend yield, 5-year average dividend yield basically is lower than the current. And when it comes to PE, it's more or less in line with where we are. and 27, and basically material sector we're looking at about 18, which is basically means it might be a little bit overvalued at the moment. If we look at the free cash flow payout ratio, okay, normally we're looking about below 60%, is about 40%, which is basically below 40%. And then in terms of earnings per share, you can see it beautifully growing. Free cash flow per share is also growing. It has come down in 2022 and basically latest 12 months, but it's expected to grow back again in next 12 months. Now, earnings per share growth, exactly the same. We've seen the numbers now. Growth, sales growth hasn't been great, okay, and in terms of numbers, but that decline there that you see is this bit here. So 33.4, and now we've already seen 32.5 when we look at Seeking Alpha. Now, as you can see here, they have been buying back their own shares. Now, this is the situation. So 2018, 2019, they diluted the shares, and I think they used those shares to basically buy another company and basically add it to their business. So something is definitely happening around 2018, 2019. So which is definitely I'm going to investigate and find out a bit more information on that. Return on equity, we're looking at about 15% right now. We're normally looking about over that 10%. Return on invested capital about 14%, which is nice and healthy. Operating margins of 25%, and as you can see, it's been in the 20s, and then it has dropped in 2018, 2019, because of they added that business into their company, and now is growing back again, which is quite nice to see. Free cash flow margin of 16%, which is quite nice and healthy. Net debt to EBITDA right now looking about 1.10. We're normally looking for below 3 for materials for this type of companies. Okay, so below 3 is what we're looking for. Right now it's way below that, which is quite nice. Right. So, and we've already seen the dividends side of things is absolutely safe. So no issues from that side of things. The company is growing their top line, growing the bottom line. It seems a dividend grower. What we now need to see is it is actually a buy. Now, the first company we're going to use is simply Wall Street. And as you can see here, it's saying 51% overvalued right now, which is quite a lot. But this company, the Simply Wall Street, if you look at Air Products and Chemicals, normally they say it's 50% undervalued. So I don't really know what's going on there. Maybe they're a bit more bullish on that one, not so much on this one. I don't know what the situation is. But when you look at the future growth, so they're expecting $271 for the price share. When you look at future growth, you can see about 8%, 9%. Now, if we look at tip ranks, for example, it's saying it's a strong buy, 449. Let's call it 450, about 10% from where it is right now. So 10 buys, no holds, and no sales at all whatsoever. Now, if we look at the future, in fact, if we look at Morningstar, it's also saying it's fairly valued right now. $411 is where it is right now. 393 is basically where they think the price should be, so not far off from where basically it should be, their expected price, but also is a narrow economic mode, so it doesn't have a wide economic mode, which is basically something that I really like, because that gives the company a competitive advantage and so on. Now, looking at the growth side of things next year, so the earnings side of things, so they're expecting the earnings to grow about 10%, then about 12%, and according to these analysts here. If we go back to Seeking Alpha and go to earnings, for example, we can see what this really means. So about 15% expected this year, about 10%, 9%. So it's actually growing nicely. Now, this year, in terms of revenue side of it, we've already seen that bit of a decline from whatever it was to 32.6 something, whatever it was, and the next couple of years it will start growing back that 5%, 6% that you expect from this type of business. This is not fast growing business basically, but they're not fast growers. That's what I'm trying to say. So they are steady Eddie kind of business that grows that 5% to 10% every single year. Sleep well at night. You don't have to worry about that kind of thing. Okay. Right, a couple of more things. Looking at from ratings, if we go to here, you can see Seeking Alpha analyst is saying it's a buy. Wall Street thing is as a buy. Quant is actually saying as a whole. Let's see the Wall Street price target. It's probably similar to tip rank. So $432 per share right now. That's about 6% upside from where we are now. Now let's compare this company in terms of return wise in the last few years. So we got the company and we got this the S&P 500. So last 5 years, you can see the company is actually beating the S&P 500. It has returned 161%, just the price return, and the S&P 500 about 92%. Now what we're going to do now is compare this, okay, with other companies in the same industry, so including Sherwin-Williams as well as automatic data processing. Again, I'm using Seeking Alpha if you're interested. I have no affiliation, nothing like that, but I'm just saying it's the paid subscription side of things. What I want to see though is the total return. I don't want to just see the price. I want to see the total return, including dividends, for the last 5 years. So have a look at this. Lint is actually returned 183%. The S&P 500 only 92%. Air Product and Chemicals have returned 91%. And Sherwood-Williams have returned 152%. Now, it's beaten all three of them, which is absolutely amazing to see. Now, if I shorten that, make it just 3 years, 65%, 28%, 10%, 32%. Again, it has beaten them, especially Air Product and Chemicals, which is another company that I actually own in the portfolio. When you make it the last 10 years, 285%. The S&P 500 has returned 160%. Air Product and Chemicals about 238. So not bad, not far off. But look at Sherwood-Williams, 464%. So they must have had a couple of years where they were growing really, really fast. So it's interesting to see how it actually competes with its peers, as well as, of course, they're beating the S&P 500. This company has an excellent balance sheet. I genuinely think it's is probably one that I will be adding to the portfolio in the next couple of weeks, because I've been interested in this company for a while. I've had Air Product and Chemicals. I have not bought more of it because I was up quite a bit. I'm planning to add more of this, but I think this company will. I like the business. I like the business model. I like the fact that kind of predictability. Right now, I would have liked maybe a bit more of a margin of safety, maybe 15%, 20%, just in case. But overall, it looks solid in terms of the total returns it's got in the last couple of years. If you look at the growth side of things are growing really nicely. The revenue side of it, the EBITDA and the operation margin, free cash flows, all of these things as well. Valuation is probably the only thing that's letting it down right now. Everything in here is basically graded a D, and like I said, earnings move going forward is actually not bad, not in a bad state at all. So I will definitely be looking into this company a bit more. I'm interested to find out what happened between 2018 and 2019, and I will take it from there. I'm going to go to the company's website. So there are a couple of things that you can do in this place. You can find a bit more information about the company, of course, but there is section on the company website called investor relations side, where you can find the presentations for this company and so on, and that's where I'm going to start. You can find the filings as well in here if you're interested. I think, yeah, so you can find the quarterly filings in here, but I think this is more of just the numbers and so on. So you can, I'm going to dig deeper, find out a bit more information, and for the look in the 10K for the last few years, and then the description part of the forward-looking statement, I'm going to read that as well, just to find out what happened in 2019. So inshallah, I'll let you know what happens. Inshallah, I'll let you know what I decide. But as always, don't take this as financial advice. Make sure you're doing your own research. Make sure you're taking care of everything you need to do before you start investing in these companies. Again, I'm only doing this to kind of entertainment, for as well as, of course, for education purposes, and to help myself and others out there, inshallah. Have a wonderful day. Assalamu Alaikum.